What's up? What's up? It's your boy CoreyB. So what I want to talk to you about today, let's talk about the stock market and what specifically I want to talk about. Now, see, when I was thinking about this and I was planning this, literally like half an hour ago, I was sitting here mulling over in my head and I was like, you know what? I really want to just get on here and kind of, bare myself, so to speak, and put my portfolio out here a little bit. And I kind of wanted to talk to y'all about my portfolio so y'all could see where I have stakes and stuff. And this is by no means, let's start from the jump. It's like, this is not a paid endorsement. I am not endorsing any companies or anything like that. I'm not endorsing you buying. I'm not encouraging or telling you to buy any specific stocks, but I just want to kind of give you some perspective on me and where I'm at. And then that can maybe give you some insight on how you can do some of your research, because that's what you really want. That is what I encourage. 100%, either you got to do one of two things. Either you've got to be willing to put in the work and do some research, or don't buy in. Go to a professional, go to one of these financial firms and have somebody do it for you. Or maybe you have a friend in the family, or a friend, a member of your family, or whatever. Maybe you know somebody close to you that you trust to manage your money. Some people do that. I tell you, tread lightly and be careful when you're doing money with family and friends. You get yourself into a shaky ground. But some people don't really want to pay that extra percentage to go to a professional. I assure you, it's almost always worth it. But if you want to really do it for yourself, then I tell you to research it, study, learn what's going on in the stock market, learn what's going on with different companies, the companies that you're like, oh, I heard this company's good, maybe I want to buy into it. Take a step back, crack open a book. Okay, not a book, maybe your smartphone, maybe your tablet, maybe your iPad, your laptop. Get online, start researching the company itself and say, where's this company been? Where's it going? What's next? What is on the horizons for this company? How is this company going to be beneficial to be in my portfolio? What am I investing? Because that's what you got to remember. You got to remember what you are doing is you are investing into the company. You are buying a piece of that company. You are taking a stake into the company, and therefore their success is your success. And that's what you got to understand. Most people miss that. Okay, so as I was mulling this over and I was like, what are the different companies that I want to touch on because I'm pretty diversified. I'm fairly diversified. There could always be more, but I'm leveraged in good ways. I've been doing this for a hot minute. I'm pretty damn good at it, and I've learned the things in our society, in our economy. I've learned the things that are going to affect the market, which the important things of knowing knowing what affects the market is you'll know when that stock is going to drop, or you'll know if the stock rising is skewed. And see, so at the end of the day, the company's value is the company's value. If it's a good company and the value's there, then the value's there. I've said this so many times on so many different videos and posts. And if you followed me for a minute, then you know that this is what I've encouraged. I'm like, the company's value is always the company's value. But what the thing is the value of the stock is just a piece of the company based on people's desire to acquire said company. So as people sell off, it's going to be worth less. It doesn't mean it's worthless. It means it's worth less. Big difference. Okay. But as I was going through and trying to, just think about what are the different companies that I wanted to touch on, it hit me. I was like, what I want to focus on most is a stock split, because I feel like as I was going through it, I was like, I want to touch on, these different things in my portfolio. And then I was like, and then I got to Amazon and Alphabet. I have Amazon and Alphabet in my portfolio. Now I may get some shade thrown at me right there, because Amazon is one of those companies that it's hit or miss with fan popularity. Some people love Amazon. Some people hate it. A lot of people hate Amazon for a couple of reasons. Some people hate Amazon because they believe that it's destroying brick and mortar. I'm not going to get into that. That's your opinion. You can believe that or you can disagree with that. I don't really care because it's irrelevant to what we're talking about. What we're talking about is money. What we're talking about is the stock market. What we're talking about is investing in your future, and whether it destroys or encourages or helps or hurts the brick and mortar doesn't matter. Your political stance or your moral stance or your any of that. If you get your emotions into it, it's not for you. Now, if you feel morally, if you feel a type of way about investing into a company like Amazon, like I said, I'm not endorsing Amazon. I'm not encouraging you. I just want to talk about Amazon because what they did is they did a stock split. Okay, so the thing is if you, I want to go ahead and finish my thought. If you feel a type of way about investing in any company, don't compromise your morals. Don't compromise your beliefs. Don't compromise your feelings and invest in a company because you think it's money, but then you don't sleep well at night because you did it. And that's kind of dramatic. Maybe it doesn't affect your sleep, but maybe you walk away feeling a type of way. You don't feel good about the money you're earning. You don't feel good about sitting counting your stack. You want to get excited. That's what you want. So you want to believe in the company because you want to get excited. Okay, so the two companies I want to talk about, like I said, are Amazon and Alphabet. And the reason I want to talk about Amazon and Alphabet is because Amazon and Alphabet are huge. If you don't know Alphabet, Alphabet owns Google. Alphabet also owns a lot of subsidiaries, but Google's the one. Google's the one that everybody knows, it's household. Okay, so with Amazon and Alphabet, the thing is off the top of my head, I don't recall what Alphabet's big number was. I think it was around 2,600, but I do know that Amazon's at one point it was 24. I think it was 24.36, something like that, right before the split. Okay, so we're talking about a share that's $2,400. Okay, to most people who are new to the stock market, who haven't invested before, and some people who actually have done it lots of times, but they're still just, for a lot of people, they see it as you buy shares. Now at one point that may have been the case. At one point that was the case with a lot of firms. It's like you bought into a company, I'm buying 5 shares, I'm buying 2 shares, I'm buying 1. That's kind of small. I'm buying 30 shares. Okay, so that's how it worked for a while, but it doesn't really work that way anymore. Now you can invest money. You're investing monetarily and you're going to get pieces of shares. It doesn't matter. You can do this right there on your smartphone. You could also go do with, like I said, financial institutions and brokerages and things like that. They can help you. I'm not a broker, and this is not my endorsement. Again, I continue to repeat that because I don't want you to walk away being like, oh man, CoreyB told me I need to buy Amazon, so I bought Amazon and it didn't work out for me. It's all Corey's fault. No, it's not. Okay, so this is the thing. Amazon, what they did is they saw that stock kept going up, which is good. It's good. But the thing is when they saw it going up, they saw the potential of opening up more stocks, more shares. So when they opened up more shares to the market, what they did, the way they did that, instead of dumping more shares in, they split the shares. So they said 20 for 1. So they did a 20 for 1 exchange, basically. So let's pick a monetary value. Let's say $500. Say you've already invested $500 before the split, right? You invested $500 in Amazon. They're at $2,400 for a share. So essentially what you've got is between a fourth and a fifth of a share, right? Between a fourth and a fifth. Okay, but when they did that split, 20 for 1, what you walked away with is you still have the same stake. You still have your $500. 5. You still have $500. But now it doesn't say, well, you kind of have like 0.22% of a share. No, what you actually have now is 4 3/4 of a share, or 4 3/5. You got 4 3/5 of a share, right? So mathematically, it's just transferred the amount of shares that you have. It has not changed your stake. Your stake is your monetary value. You still have $500. Well, now, okay, so to all the people that happened through the pandemic that started taking their pandemic paper, so they started taking this their COVID money. God, I still can't wrap my head around the fact that that was a thing. So I had a homeboy. I got my pandemic paper. So check it out. So people started taking their money and they're like, well, I can't work, but I'm getting this, you know, these relief funds from the government. Maybe it's a good idea. I'm just sitting at home anyways. I should invest in the stock market. Good for you. Fine. Whatever. I ain't mad at you. Maybe you should have paid your bills, but you know what I'm saying? You invest in the stock market. I can't say you did bad unless you didn't know what you're doing. But that's what a lot of them didn't. And some of them are like, oh, Amazon's great, right? Alphabet's great. So they just bought into these big ones and they just put their $500 in, put their $200 in, put their $400. But then when it sold, and at the beginning they were looking at it like, man, I bought in at 2,000. Now it's worth 200, or it's 2,400 or 2,200, and they saw the value of the stock going up. But then when they saw it drop, and now it's all of a sudden it's worth 124.35 a share, and they're like, I lost all my money. What did I do? I lost all my money. No, you didn't lose any money because your your value is still the same. You put $500 in, you still have $500. Actually, if you put $500 in when it was at 2,000, then you're sitting around like maybe 700, 600. You know, it's like your money grew because of the influx, because of the increase, because of the growth in the stock. But when they did the split, you didn't lose stake. You gained shares. Just the value of each individual share went down. Okay, but people didn't understand that. I've got friends who still don't understand that. They're like, I don't get, why would they do this? Why would they do it? Okay, they did it with purpose, because the more people who buy in, the more value that company, the more perceived value that company has. And the company can use that perceived value as leverage. They can leverage into other avenues and aspects, and they can leverage into more capital. So the thing is what happens is when they split, it encourages more growth, because you've got more customers who are like, man, okay, I've never bought in the stock market before. Let me go look at what's going on. Let me, and they start asking their buddies, hey, what's a good stock? What's a good company? I don't really know. And so as they don't know, they start thinking about big companies. What's a big company? Oh, yeah, Coke is a big company. Is that a good stock though? I don't know. It's a soda. Is it a big stock? I don't know. And they're like, Amazon. Amazon during the pandemic was such a hot button. It was the company that was keeping this nation, I don't know. It was one of the many contributors to people being employed and the growth of this economic structure during a very struggling time, because they were delivering everything directly to your house when you couldn't leave your house. So this was a huge thing. So while Amazon was in the news everywhere and everybody saw Amazon on everybody's doorstep when they went outside, so Amazon became a thing that everybody knew. So they're like, well, let me check out what Amazon is. So they get on their phone and they look up the stock and they're like, oh, Amazon's only $124. Like they just discovered something. So they feel like they just discovered something. But they really didn't. I mean, they did, but they didn't. They think all of a sudden they've walked into this gold mine. They're like, how is it only $124? I can afford that. So they're like, I can buy 4 shares. I can buy 5 shares. I can spend $500. And so all of a sudden they think they can buy something that otherwise, if they had looked at it before and they saw that $2,000, they were just like, can't do that. Never going to be able to do that. Okay, so that's the thing. See, that's the key right there. So what it does is it encourages an influx of shareholders. Why is shareholders good? Because the more shareholders you have, it increases a perceived value. That perceived value increases more potential leverage. The company can leverage more. The company can grow. And that value actually does increase. Perceived value gives leverage. Leverage gives potential for growth. Growth increases value. It's a cycle. It is a cycle that too many don't understand, but it makes logical sense once you understand it. And that's what I'm doing is I'm trying to break it down for you. So Amazon, like I said, it's an incredibly sexy stock. And the reason I say that is because as it has that potential for people to as it has the potential for an increase and an influx of new shareholders, it had too many people panic, especially as we've gone through this struggling. 2022, we had a rough first quarter, a bad second quarter. Third quarter looked a little promising, and fourth quarter was rough again. And we're rolling into the new year, and people have been selling off a lot of their shares because they're like, I don't trust the government anymore. Government? This is a stock market. But people associate the two. They're like, well, the stock market, it's the government. It's all just controlled. And some people say that stock market controls the government. Others say the government controls the stock market. At the end of the day, the consumer controls the stock market. People don't understand that. And we'll get into that in maybe in my next video, we'll talk about that. But the consumer absolutely controls the stock market. It's not the government. It's not the company itself. It's nobody. It's just the consumer. Nameless, faceless consumer. Me, you, all of us. We are the consumers, and we are controlling that market. Okay, now, with that being said, you had all these people panicking. And they're like, well, I need liquid money. I don't trust the stock market anymore. I need liquid money. I don't trust the government anymore. I need liquid money because what if something happens at my job, or something did happen at my job and I just need some extra bank? So they sold off their shares. They sold off their money. And some people just didn't understand the stock market. And they're like, well, it's down to 124. I had 2,300. So I'm selling now because right now I haven't lost any. I invested 500 and now I'm at 625. So I'm just cutting my losses. I'm taking my 125 bucks and we're calling it a day. And at the end of the day, I can't say that they did a bad thing because they did walk away with profit. So with profit, good for you. And $125 on 500 bucks, that's 25% profit. Way to go. Many people walk away with a lot less. So a lot of people cut tail and run. And so when they did, that stock, it kept tanking. Not tanking. It didn't tank, but it did drop. I mean, right now it's sitting at roughly $88. It was at 124 when they did the split. That's a significant drop. It is. But that's what I'm here to tell you. It's blue light special, baby. It's time to be a bear. It's time to be a bear in the market. You know what I'm saying? We're going through a recession. Recession is when millionaires are born. Millionaires are created and spawned out of recession. This is your opportunity to do something. You don't want to buy into Amazon? Don't buy into Amazon. I am not telling you to buy into Amazon. I'm telling you, don't get confused by the stock price. Don't look at that stock price and be like, it says it's 88. It says it's down by 17%. I shouldn't buy in. Do you believe in Amazon? If you don't, walk away. Don't buy Amazon. But if you believe in the company, if you look at the company and see where they're going, where they've been, what their potential is, what their new innovations are, what their plans are, what is their business model? Do you know their business model? Do you know the overall? McDonald's is a great one. Most people miss what McDonald's business model is. McDonald's is a corporation, and the majority of its money is not in burgers and fries, but burgers and fries. It's not. It is not in burgers and fries. I'll tell you what it is. It is real estate. A lot of y'all may know that, but a lot of y'all may not. But the reality is McDonald's, their biggest holdings are in real estate because they own all of the properties. And as they own all the properties, they sell franchises. So you can get a franchise. You can get a McDonald's franchise. And as you go and apply, you go through your due diligence, you do all your paperwork, you apply for a McDonald's franchise, and you're like, okay, now I'm going to set up shop on this corner. They own that property and you're paying them rent every month. Yeah, McDonald's is heavily leveraged in real estate, which is why McDonald's is never going anywhere. Love McDonald's. Okay, so like I said, understand the company. Again, not an endorsement for McDonald's, not an endorsement for Alphabet, not an endorsement for Amazon. This is just me trying to shed light on perspective. Understand what the company is. If you understand the structure of McDonald's, you understand the economics that goes into McDonald's, you understand what goes into Alphabet or Amazon, then you can make an educated decision of whether that's a stock that you want a piece of, whether those shares of that company, whether you want to leverage yourself and gain a stake into that company. Do you want to? Is it worth it? Do you see the benefit? Know that and understand that. Let's talk more. Comment below. We can discuss these things. I would love to have your thoughts, your feedback. Like, what is it that you don't know that you'd like to know? What is it you know that you might be able to let your boy in? Because you know what? We're all still learning things. We're all still learning things, and there's more to learn. So, like I said, what makes Amazon incredibly cool and Alphabet incredibly cool is right now their stocks look like they're losing money, but it's because of a split. So if you don't want to buy into Alphabet, don't. You don't want to buy into Amazon, don't. But if you always wanted to and now you just think, oh, maybe I shouldn't, read up a little bit. Let's understand what the company is. Do you believe in the dynamic? Do you believe in the principle? Do you believe in their business model? And is it something you can get behind? If it is, then let's start making some money. Remember, as I've said before, some of these things you're going to hit bank. You're going to hit pay dirt like quick. But the best ones won't be fast. The best ones will be slow. Take your time. Invest some money. 2 years, 3 years, 5 years, 10 years. I mean, have perspective. Be willing to take the time that's necessary in order to allow your leverage to grow. I hope this has been helpful. I hope this has shed a little bit of light on why Amazon and Alphabet look like they're not worth what they really are. Their value is huge. Value is huge. But you don't have to buy into that company. There's lots of other companies that value is huge. And they're definitely not the only companies that have done a split. They're just two big ones. They're two big ones that are household names. I love using household names. I love using companies that all of us have heard of, because if you're someone who's new to the stock market and you're new to understanding this, if I talk about something like Tesla or McDonald's or Amazon or Apple, something that is in the news, something that is in your house, something that is a household name, something, whether you like them or not, you'll understand what I'm talking about. So it's great to give transitional examples for you to grasp the concept, and then you can take this information that I'm offering you and utilize it to more thoroughly research and investigate other companies and other stocks that you'd like to leverage and that you'd like to invest in and that you'd like to get into your portfolio. Take some time and let's understand what we're buying into. All right, it's your boy CoreyB. Be sure to give me a like, hit that heart below, hit the subscribe button, ding that bell, get your notifications. Y'all stay tuned. I got so much more coming at y'all, and I'm gonna keep putting down more content. I'm gonna keep putting stuff out here because this is important that we grow together. We lift each other up and we grow together. All right, it's your boy CoreyB, and I'm out.